Hi, my name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor to your organization's workplace retirement savings program. Today, we're going to check in on what's been going on in the markets so far in 2022, and we're going to do so through a piece called Student of the Market. Our goal for this series is to build a foundation of investment knowledge for you as a participant in your organization's workplace retirement savings program to make confident investment decisions both in that plan and beyond. So let's get started and take a look at what we've seen so far year to date in 2022. And the big story is continued volatility and a historically bad start for bonds. And by historically bad, I mean truly terrible, literally the worst start ever to a year for bond investors. And there's no doubt that it feels that way. We're down 9.5% for the core bond index through the end of April to start the year. Second place was 1994, which was down 3.6% to start the year. 94 was also previously the worst full year on record going back to 1926. And if we look at some of these years in here, we see 2018, 2021. These were very much products of a low interest rate environment. Today we're in a much better shape with an income cushion of close to 3% on 10-year treasuries versus at the end of 2020, we were less than 1% on the 10-year treasury. So, looking at some of these periods when we were off to a slow start for bonds, you can see that the next 8 months, the next 12 months, on average, bonds were higher, and investors who stuck with it were rewarded over longer periods of time when we take a longer-term view. So speaking of taking a longer-term view, what if we look at some of these rolling periods? And so when we look at the chart here, we can see that we're in the second worst one-year rolling period for bonds in history out of 1,145 periods going back to 1926. Now, if we look at the left-hand side of this chart, though, and we take that longer-term view, we can see that the longer the holding period, the greater the likelihood of success for bond investors. And history has shown us that, again, those that take a longer-term view and that can, tune out some of the near-term noise and ride out some of the volatility, even though it's uncomfortable, do tend to be rewarded over long periods of time for that discipline. So let's go ahead and let's look at how stocks have started year to date. So if we look at stocks here, we can see that also off to a slow start, down almost 13% for the first 4 months of the year. This surprised me. It's actually the third worst start to the year. However, similar story to bonds. What does history show us 12 months later? Well, on average, 12 months later, investors were up 14% for the year and 24% 2 years out. So again, having that plan, sticking with it, having that longer term view has certainly helped investors, over time. Now, let's talk about this volatility that we've been experiencing. We talked about volatility in our last market update. So if we look at volatility year to date, we can see that as defined by 2% or greater market moves in a trading day, we've had 12 year to date, which would put us on pace for 36 on the year. Definitely higher than recent years, but still well off the great financial crisis in 2008, which had 72. And if we factor in that there's only 252 trading days in a year, that's a lot of volatility no matter how you slice it, and it's felt that way. And when we look at these chunks of volatility, if we look at the years, we can see that there was a lot of uncertainty in these periods. And that's really, the market doesn't like uncertainty. Right now we have geopolitical pressures, we have inflationary pressure, we have interest rate risk, and the market's really trying to find some direction, and you're seeing that with this uptick in volatility. So what are our takeaways here? As a long-term investor in your organization's workplace retirement savings program, there's been nowhere to hide, right? Stocks are off to a bad start, bonds are off to a bad start, and it's really felt that way for most investors. So, what are some strategies that historically, investors could deploy in environments, like today, that share some similar characteristics, and really, it goes back to being disciplined, having a plan, whether you're using the defaults within your retirement savings plan, working with a financial professional, first and foremost, have a plan, be comfortable with that risk level, know what your risk level is, and having that knowledge can give you the confidence to ride through these periods of volatility that are uncomfortable, and it's important to acknowledge that. So with that, have a plan, stick with it, and make sure that we have that long-term perspective. So with that, I'm going to show some brief disclosures here. Thank you so much for joining us, and we look forward to speaking with you next time for our next update. So thanks so much, and so long.